Are you always the first call your clients make before any significant financial decision is made? Or do you sometimes find out after an action's already happened? As wealth becomes more complex, your clients need guidance that extends well beyond the traditional portfolio. Business sales, real estate transactions, tax decisions, equity compensation, and other forms of money in motion can have a far greater impact on their financial lives and your relationship. I'm Duncan MacPherson, CEO of Pareto Systems, and for over 25 years, my team has helped financial advisors build more consistent, predictable, and purposeful businesses. In this clip from the Always On podcast, we explore how the advisor's role has evolved, what it means to become a true wealth manager, and how becoming the first call can strengthen client engagement, fee worthiness, and long-term relevance. Ultimately, future pacing enables a financial professional to get out in front of, but as close as possible to any and all forms of money in motion.
Right.
And so as we've talked about before, the big distinction between pitching and positioning, first of all, the benefits are the advisor has to reimagine what it means to be the first call, where a client understands they're always contacting their advisor before any significant decision is made, never after. And I don't know about you, but we're seeing that happen where advisors get almost like an afterthought in some ways because the client didn't know that they could play a role in a complex decision because the advisor sort of painted themselves into a bit of a corner based on 60-40 and other forms of representation. So first call I want to talk about, based on money in motion and liquidity events, total client engagement as the client's life unfolds and their needs evolve. That perception that they can't outgrow the advisor because they're actually growing into the advisor's process. So,
yes.
So first call, total client engagement, and fee worthiness. Alternatives and this positioning, there's an opportunity for a client to have a refreshed perspective on why the advisor is compensated rather than how much they're being compensated. So with that as sort of like three of the many benefits that come from this positioning, again, let's get into the weeds on how the advisor's role has evolved, the client's needs have evolved, and how that's actually accomplished, like based on your scenarios.
Yeah, and I think that's a great place to unpack what has changed in the world, because that's what's led to what's evolved the financial advisor's role and responsibility, right? So you sort of laid out the career progression for many people who have been in the seat now for a long time, where they started as an investment rep. Nobody really liked that term, but it was pretty appropriate for what was happening at the time.
Right.
We were representing investments for people who would obviously benefit from owning them. Then we moved to financial advisor, which was the evolution into I'm really not a salesperson. I'm providing strategy and advice to people, but that was limited to things that weren't very far outside the portfolio. And the people we're talking about now, Duncan, or the ones that we should all be aspiring to be, are the wealth managers, which is the one that doesn't ignore the things outside of the portfolio. In fact, recognizes that those things are in many cases much larger and have bigger implications than the things that are in the portfolio. So the key to being the first call is understanding how to navigate complexity and change. And that's really what has helped the advisor role to evolve, was the needs of the clients have evolved too. And what they need from their advisors now is different than it was when I started in the business. So a quick history on that I think might help. And that is, if we went back one full working career from where we are right now, That's 40 years ago, and we're in 1986, right? Well, in 1986, greater than 80% of all people in large and medium-sized companies had pensions. But life expectancy was ever increasing and interest rates were on the decline, and that lasted for a long time, which makes a defined benefit hard to support.